Yep. Well, good evening, everybody, and welcome to part 2 of our mini-series on consolidated accounts. Everybody's favourite topic, including yours truly. Now, before we start, I've been asked to make a small announcement. Next week's session, number 3 in the series, which is Consolidated Statement of Profit or Loss, will now start at 7 p.m. and not 6:30 as originally advertised. So if we can all make a note of that. Right, without further ado, let's get the ball rolling. This is part 2 in a series of 4 on consolidated accounts. Last week we looked at goodwill. This week we're going to look at intra-group transactions where one group member sells to another, and the unrealised profit that can sometimes arise that we have to adjust for. So, in part 1, we talked about what a group of companies is, explained that it exists when one company has a controlling interest in one or more other companies. The holding company is referred to as the parent and the other is a subsidiary. Always remember that each individual company prepares its own accounts. 2 companies may well be in a group, but the people who work in those companies may have no knowledge of this. So each of them is a freestanding company, it prepares its own accounts. But in addition to those accounts, there is a requirement that the directors of a parent company of a group must produce group accounts which summarise the whole business as seen from the outside. And essentially, that really is just a matter of adding up the separate transactions, adding up the assets, adding up the liabilities. But there are complications, because we must only show in the group accounts those transactions that involve people outside the group. Anything that takes place entirely between group members, we simply ignore. Only a sale by a group member to an outside customer is shown in the consolidated account in the revenue figure. Likewise, only purchases that have come from an outside supplier. Now, this was a topic that back in the day I struggled terribly with, and I hated this topic. And for me, the turning point came when I started to picture it using a diagram. And it's a very simple diagram, and I'll show the first example now of how we do this. You need to draw a circle or an oval or an egg, call it what you will. This circle represents the boundary between the group and everybody else. Within our group, this particular one, we've got 2 companies. We've got a holding company, which we'll call Reeves PLC. There it is, that's a holding company. We also have a subsidiary, Mortimer Limited. And now let's use this diagram and show you how you can use it to simplify workings. This is a fairly straightforward example, but it will get a little bit trickier further on. During the year, Reeves' sales are valued at £1.5 million. Mortimer sales. Yes, Angela is the answer to that. Holding company, parent company. Whoops, I've slipped into old speak there. Sorry. Mortimer says 900,000. All the sales are to customers outside the group. No items are sold by one group member to another. So quite simply, working for that, there's our group, Reeves and Mortimer. Sales by Reeves cross the line. All sales go outside the group. Mortimer, all sales outside the group. So the figure that's going to appear on our consolidated statement of profit or loss, quite simply, add them together, £2.4 million. If only it was always that simple. Let's look at cost of sales. During the year, Reeves makes purchases, cost of sales valued at £800,000. Mortimer buys £500,000. Everything is bought from suppliers outside the group. Nothing is bought by one group member from the other. Actually, we already knew that because there was no sale from one group member to another. So plainly, if there's no sale, there can't be a purchase. Now, let's carry on with the working. There's our group, Reeves, Mortimer. £800,000. All of it has come in from outside the line. Mortimer, 500, all from outside. Just add them up. 800 plus 500, £1.3 million. So if we were to produce a very simple final account, we've got group sales 2.4 million. We've got cost of sales 1.3 million, which gives a gross profit of £1.1 million. You might make a note of £1.1 million because we'll see that number again shortly. Now, of course, it isn't always quite as simple as that. When one group member does make a sale to another group member, we have to make an adjustment for it. Let's assume the same total figures as before, but with one difference. Some of the items sold by Reeves were not sold to customers outside the group, but instead were sold to Mortimer. Here we go. During the year, Reeves sales £1.5 million. This includes sales to Mortimer of £200,000. This means Reeves sales to outside customers must be £1.5 million minus £200,000, which is £1.3 million. Mortimer sales are £900,000, and all of this is to customers outside the group. Draw the diagram. Reeves, Mortimer. There's the sale from Reeves to Mortimer. Reeves sales to external customers, therefore, are 1.3 million because its 200,000 has not left the group. Mortimer sales, no change, all external. So if we want to add those figures up, once again, 1.5 million plus 900,000. This time it's minus 200,000, so the sales are lower than the first example. Alternatively, we could just say 1.3 plus 900 is 2.2. Now, let's look at cost of sales. The same logic applies here. During the year, Reeves' cost of sales is valued at £800,000, and we've already said that all of that came from outside. Mortimer's cost of sales is £500,000, but because Reeves has made a sale to Mortimer, we know that some of Mortimer's cost of sales must have been bought from Reeves and not from outside. Let's draw the diagram again. Reeves makes a sale to Mortimer, or alternatively, Mortimer buys from Reeves. Reeves purchases cost of sales entirely from outside. Mortimer's cost of sales, 300,000 has come from outside, because out of the total of 500 we must deduct the 200,000. So when we show this on the consolidated income statement, 800 plus 500 minus 200, 1.1. Now here's an interesting point. Notice that our group sales now 2.2, cost sales 1.1, our gross profit is still £1.1 million. It's the same profit because the two have simply cancelled out. Is everybody happy so far that this is all making sense? Sam is riding shotgun if anybody has any questions to ask along the way. Okay, thank you for the yes. Okay, now let's go to the next stage because life is never that easy. A problem arises if, right, here's where it gets tricky. When goods are sold by one company to another in any case, it'll always be the case that the seller is going to want to make a profit. So Reeves in this case will have charged a higher price for these goods than they paid to their original supplier. If all of those goods are subsequently sold by Mortimer, there's no problem. The goods have been bought, they've been sold, money's in the bank, the profit has been realized. Where we do have a problem is if at the end of the year some of those goods are still in inventory. Now remember the rule, inventory is valued at the lower of cost or net realizable value. So if an item is bought by Reeves from outside, a profit is added, it's sold to Mortimer, and it's still there at the end of the year, the cost of that item is the cost of the goods when they entered the group, i.e. they were bought by Reeves, not the transfer price that Reeves has sold them to Mortimer at. So they're not worth what the individual company accounts for Mortimer say they are. So let's look at the story of these items again. We're told, and this is the kind of information that you will pick up in the notes. Reeves adds 25% markup to the cost of items bought, which those of you that are handy with markups and margins, and that is a topic for another day, means that 20% of the price they charge is profit. 200,000 times 20% means the profit included in that is £40,000. Take that 40 off, leaves 160, add 25%, sure enough, it's the same 40,000. Anybody not happy with markups and margins, do drop your tutor line. We've got some good notes on that because it is a popular area that we all struggle with. So now let's draw the diagram again. There's our group. There's Reeves. There's Mortimer. Reeves buys goods for 160, sells them on, adds profit to 40, sells them on to Mortimer for 200,000. So that's the transaction as it's happened. So anything, if at this point Mortimer had those goods in inventory, their true cost is 160, not 200. As we've said, if they sell them before the year end, it doesn't matter because the profit now has been realised. If they're still there at the end of the year, we have to value them at the price at which they crossed the line when they came into the group, not the price that they changed hands within the group. The profit of £40,000 that Reeves has added is at this stage unrealised. It's only going to be a real profit when the goods are sold on to proper customers outside the group. If you take a ridiculous example, you could have two companies in the group. One could sell to the other for £1 million, then they could sell them back. They could generate millions of pounds worth of turnover selling the same goods back and forth, and it would be meaningless because until a proper customer comes along and buys the goods, it's not a real profit. This profit will be realised once the items leave the group and are sold to proper customers. So we need to make an adjustment. And again, let's think now about cost of sales. Now here you've got to cast your mind back to the advanced diploma and when you first learned to prepare final accounts. Opening inventory, we'll have to take a poll on that. Inventory, add purchases, subtract closing inventory, this is the key one, gives us cost of sales. Closing inventory, focus on that for a second. So when we're calculating cost of sales, we subtract the closing inventory. So that means if the closing inventory goes down in value, we're subtracting a lower amount. If you subtract a lower amount, you are left with a higher amount. So the effect of a reduction in closing inventory is to increase the cost of sales. Let you think on that for a second. Because we're subtracting a lower amount. That is a point. When you sort of go through it slowly, step by step, it seems a bit obvious, and yet that is a very popular area that it's tripped us all up in our time. So, during the year, Reeves' cost of sales is valued at £800,000. Mortimer's is £500,000. It includes items bought from Reeves for £200,000, which includes a profit of £40,000. These are unsold in Mortimer inventory at the end of the year. As before, sales, no change there. Reeves external sales, Reeves sales total plus Mortimer sales minus the intergroup item, £2.2 million. Cost of sales, Reeves 800,000, all of it came from outside. Mortimer 500,000, minus the 200,000 that came from Reeves, but plus the unrealised profit. So our cost of sales now is 1.14 million. Let's put it into our final accounts. Group sales 2.2 million, cost of sales 1140. Our profit is 40,000 less than in the earlier examples because 40,000 of our profit has not been realised. Put another way, our inventory is worth £40,000 less than we thought it was. We being everybody who's in the group. We've reduced it by 40,000, and that will be realised when those goods are sold. Let that sink in for a second. Okay. A further twist. There won't be many more of these, don't worry. Well, almost always the question will say that only some of the items are unsold. Typically, it'll be half. So, if half of the items have been sold, then half of the profit has been realised. So let's say that Mortimer has sold half the items bought from Reeves by the year end. The profit in the original consignment, 200,000 less 160, was 40. Half of that is a profit of £20,000. The other half, like we said, we'll be allowed to recognise that once the rest of those items are sold. Once again, group sales, no change there. Cost of sales, 800 plus 500. You'll always have that matching pair, the gross value of the sales and the gross value of the cost of sales. They will always match. But this time, the unrealised profit is just 20. So 1120, put it in the final accounts, 2.2. Take away 1120, leaves us with 1,080,000. And this time, only a £20,000 reduction. That really is all there is to unrealised profit. And it's one of those that we all struggle with. And yet, if you break it down, more than anything else, picture those goods coming into the group at one price, travelling through the group at another. You can see visually why it's come about. And once you get the why on your side, the rest of it's not too bad. Okay, just a couple of final thoughts. When you're consolidating, I've mentioned tonight's about intergroup transactions, not just unrealised profit. Just the same as a sale and a purchase cancel out, so does a receivable and a payable. If in this case Mortimer owed Reeves £100,000, it would be showing as a liability to Mortimer. That would also be showing as a current asset as a receivable for Reeves. So they cancel just the same way. So because they cancel out, the total value of the net assets isn't affected. We gain one with one hand, we lose with the other. We've mentioned that the group closing inventory isn't worth as much as we thought it was. So that, when we come to do the statement of financial position, that will need to be adjusted for the unrealised profit. And then one final type of transaction within the group that we frequently meet, if in this case the holding, what was the holding? Let's say one parent company owns 80% of a subsidiary. If a subsidiary pays dividends during the year of £100,000, 80,000 of that will be paid to the parent company because the parent company owns 80% of the shares. So you need to cancel those out. Typically, you'll see that the parent company will have income from investments, and it might include other investments that it's got in other companies elsewhere, but the element that has come from the subsidiary would need to be subtracted. And that really is it for tonight. We've 2 more sessions to go after this. These will be a bit longer than tonight and last week. The first one, we're going to look at how we pull all the bits together to draw up a consolidated statement of profit or loss, also referred to as an income statement. And then the 4th final week will be the consolidated statement of financial position. The end. It just remains me to say, if you've any questions, please fire them away. And if not, then thank you for listening. I hope tonight's been useful, and I look forward to talking at you all again before long. Thank you. Well, thank you for the comments. Right, good night, everybody, and we'll see you next time.